Yesterday, after market close, we had two massive juggernauts in the stock market report. We had Microsoft and Alphabet, and what an earnings it was for Alphabet. Not only did they have a strong beat, but for the first time ever, they have announced they will be paying a dividend. So in today's episode, we are going to do a deep dive of this company, which is up over 12% after the announcement in the pre-market. We're going to take a look, see whether or not this now dividend-paying company is one we should invest in. We're going to look at how strong this company has grown their revenues, their top line, as well as their bottom line. We want to see how much cash they really have on the balance sheet, what their total debt is, so a quick look at the health of this company. And as always, we are going to take a look at their metrics to understand their free cash flow growth, their sales, and a lot behind the numbers. And what's also interesting is we want to see what insiders have been doing, those who knew of a dividend announcement, as well as the institutions. Is this a company they continue to buy? And as always, we will take a further look at these numbers in comparison to the previous quarter and year. Now, don't forget, we are going to run it through the valuation model. We do want to understand what is the intrinsic value, what is our acceptable buy price, and now after the earnings, what is Wall Street predicting for the share price over the next 12 months? Firstly, when we do take a look at the market over the last few months, year to date, we can in fact see that overall there are some mixed numbers. We see some green, we also see some red, but when we specifically look at the communication services, both Google and Meta have performed very strongly, and now with the announcement of their earnings, as we said, Alphabet shares have gone even higher. They're now up just 14%. Will be interesting to see when the market does opening. And as we mentioned, they are now paying their first ever dividend. So let's take a look at this company, their earnings. And what we also want to point back that might in fact have gone under the radar is that they have announced a 70 billion buyback as well. So in terms of the numbers, if we put the dividend to one side for now, we can see they smashed through on the earnings per share, 189, with analysts expecting 151. And they also had a very strong beat, nearly 2 billion higher than what Wall Street were targeting of 78.59 billion. On top of that, Wall Street also look at some other metrics. YouTube advertising came in significantly better than expected, just over 8 versus 7.72. Google Cloud revenue also looking very strong. So we can see that not only have they announced a dividend, which you could argue has some part of the increase in share price, but their earnings are much better than what Wall Street had expected. And for those that are very excited about this, what we can see is now that they have approved a cash dividend. This will be 20 cents per share to be paid in June, and you will have needed to have held that shares by June the 10th. Quarterly dividend as well, so it will be recurring into the future. Now, on top of that, whilst that is very good news, they have also announced and authorized the repurchase of $70 billion in shares, which is very, very strong. As always, when we do analyze companies, we also like to see a reduction in those shares outstanding. So this is a very strong double win for Alphabet shareholders. And if you are a regular viewer, you know that we have done many videos on Alphabet where we have talked about this as one of the cheapest tech stocks to own. Now we're going to do our deep dive to see whether or not that is still the case. Straight away, we have 3 buy ratings, and in fact, we have one analyst with a strong buy rating. When the market opens, it will now be trading at a new 52-week high, and the forward P will be slightly higher than the 23.4 that we do currently see. Now, over the last year, it is up over 50%, and if you have been a long-term shareholder, you would be up 484%. Now, when the market opens, this will now reach new all-time highs, so very exciting for those current Alphabet shareholders. In terms of the company, what is the direction it has been going in over the longer term? Well, with the more mature companies, a 3 to 7% baseline rate of growth. With Alphabet, a tech company, we do expect a larger growth rate. 66 billion reported in 2014, 307 in their latest annual accounts. And what we can see And something we do want to see with companies we invest in is some very, very nice growth on the top line year on year. In fact, this is a very nice graph to see, consistent increases to their top line and very strong numbers. We will look shortly to see that they have been growing nearly every year at double digits consistently. Bottom line, a very similar story. 14 billion reported in net income in 2014, 74 billion in their latest annual accounts. We can see a little bit of inconsistency over the longer term. Nonetheless, it is moving in the right direction, and similar to their top line revenue, does grow at a very sharp rate as well. When we take a look at their balance sheet, as always, we look at their total cash and short-term investments versus total debt to get a sense of a health check. 62.6 billion of cash in 2014, 111 in their latest annual accounts. So they are sitting on a ton of cash. Probably one of the reasons why they are doing both share repurchases as well as a very nice starting yield. And we can see cash has essentially increased over the longer term, but again, very marginally, as we can see. In fact, some years we note decreases. When we take a look then at their total debt to understand this company a bit better, what we can see, it has gone from around 8 billion in 2014 to just under 30 billion. So whilst they do have a total debt that has been increasing, we can see their total cash well above 100 billion, more than enough to pay all of this debt if they need to within one day. So balance sheet looking very, very strong. Now, a few things that we like to analyze are some of their ratings on the growth as well as profitability. On a growth rating, straight away we have a B grade. Now, the reason for this, year-on-year growth, we can see 8.7%, a lot better than the sector median of 2.5%. Forward-looking, 10.2%, again significantly better than the sector median of 2.7%, and with some other ratings we can see looking fairly strong, for the large part better than the industry average. One thing I quite like to look at is the earnings per share expected increase over the next 3 to 5 years, 17.2%, with the sector median at 10.43%. So overall, the gradings look very positive for Alphabet on a growth perspective. When we analyze this on essentially a profitability basis, we see an A+ rating overall. Few things to look at. Gross profit margin 57%, very nice. Sector around 49%. Bottom line margin 24% as well. As we can see, the sector is significantly lower, and across most of these metrics they have performed very, very well. So this is a very good sign for this company, which looks to have a very strong profitability as well as the growth rate, which also looks fairly decent. Now, in terms of the interactive media and services industry, we can see others. We have Meta, Tencent Holdings, as well as a few others. What we can see now, over the last year, total return, Alphabet up 50%. With market open, this will be higher, although not as high as Meta's 113%. When we extend this over the last 5 years, we do see that Alphabet is in fact one of the best performing, up 146%. And in fact, with market open, they will be very, very strong. In fact, number one over the 5-year period. Over the last 10 years, though, we can see they do come second to Meta. Nonetheless, incredible 484% increase over the period. As always, though, bear in mind, past performance is not an indicator of future. Now, insider ownership is 0.88%, so fairly low, although we do see a significant amount of insider sales over the last 12 months. 10 insiders, as we can see, 105 million, although we do note one insider buying of around 9 million. Now, when we do take a look, in fact, over the last 2 quarters in 2024, we do see quite a significant number of insider selling. When we take a look to note who this is, we can in fact see the CEO himself on the 17th of April did sell 22,500 shares, $157, around 3.5 million. Now, bear in mind, this is why we always say on the episodes that insider selling is never a bearish signal, because let's be honest, the CEO just a few days ago would have known whether or not they were going to pay a dividend, and if he really thought that the share price would have gone up, he would have sold. So, and this is one of the reasons why we say insider selling isn't necessarily a bearish signal, because let's be honest, the CEO would have known just last week that they would have initiated a dividend, so really he would have kept those shares. Hence why we never know why they sell. It could be personal or financial reasons. So we don't read too much into insider sales, more into insider buys, which we do believe as a strong bullish signal. In terms of institutional ownership, well, it's 40%, 49 billion worth of sales, around 52 billion worth of buys. So not that much more buying than selling. When we do take a look at Q1, a very similar scenario. We see a little bit more buying than selling, although the last 2 quarters before that we see the opposite. So overall, yes, institutions are buying a little bit more than they are selling, and we can also see the same here in Q1, that most recent period. Now, when we take a look at their first quarter 2024 to compare it to their first quarter in 2023, we can see their revenue has increased significantly, 80.5 billion from last year's 70 billion, and this, as we can see, is an increase of 15%. When we take a look at their operating income, also up very strongly from 25.5 billion with that quarter last year 17.4. We also note very positive that their operating margin has increased from 25% to 32%, and we can also see their bottom line has gone from 15 billion to 23.7. We also note that their earnings per share has improved as well from 117 to 189. Now, also, just to let you know, we have released our latest free weekly article. If you do want to gain access to this or any other articles, all completely free, do click on that pinned comment below. So let's jump into their metrics. Now, a few things that we always want to look at when investing in companies. We want companies that increase their free cash flow over the long term. We can see that with Alphabet in today's episode, very strong increases over the longer term, and even into FY24, it is expected to continue 641 as well. So very positive. Yes, a little bit inconsistent, but overall moving in the right direction. We then have the sales growth. As we mentioned earlier, their top line revenue nearly every single year growing at double digits. And even though we do see a slowdown into 9% 2023, we can see on a trailing 12-month basis, they have increased their top line by 12%. And when we just look at this quarter, as we mentioned, 15% increase from that quarter last year. So overall, we do expect this double-digit increase to their top line sales to continue. Now, in terms of sales, well, another way of how we analyzed earlier, but when we look at their shares outstanding, not only has it decreased over the longer term, as we can see clearly, they've bought back 1.1 billion worth of shares, which does effectively return excess cash to investor pockets, but they're expected to do around 80 billion worth of share repurchases, as we mentioned, on top of initiating a dividend. So lots of positive moves coming out from this latest earnings. ROIC, one of my 7 golden dividend metrics. You really want to be looking at companies that have a minimum of 10% just to give you faith that management are able to effectively allocate their capital. Last 3 years looking very strong in the high 20s. Trading 12-month at the 30s. It looks like this is something that is improving for Alphabet alongside other metrics too. Operating margin, well, very strong, above that 12% minimum. Free cash flow above the 7%. So, although you could argue a little bit of inconsistencies year on year, the numbers are looking very strong, and it does make this very attractive for investors as well as potential investors. The net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Now, this correlates to balance sheet, so we can see 0 across the board, meaning it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. And also, they are initiating a dividend. Given this is 0, their dividend safety should be sitting on 99 as well. Very safe. Let's take a look at the stock valuation. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button, and don't forget to have those notifications on. So let's take a look at the first model, the multiples valuation model. Companies in a similar sector and size. We have their P multiples, the average multiplied by the EPS of Alphabet to get an intrinsic value of $174. We have an overvaluation signal, but it isn't too far off, so we could argue reasonable valuation. Bear in mind, though, we don't look at any of these models in isolation. We then have the free cash flow year on year. As we can see, the average is around 24%. We've gone a lot more conservative at 12, which is also lower than the more recent increase and lower than the average growth rate. In conjunction with the discount rate, we have the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get to the intrinsic value, which gives us an undervaluation signal. Now, bear in mind, we have used 12% on other episodes. We have gone through other different levels. So if you are someone that does believe that it should be a medium growth rate of 14%, you can see the value that would be derived, as well as a high giving you $281. As always, though, you can grab a copy of this model by clicking on the pinned comment below, and you can get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio, as well as those in your watch list. So the intrinsic value in today's episode is purely the average of these two models, coming to 194. And what we normally do is we start off with a margin of safety of 10%, and we execute on that if we believe it meets 3 golden criteria. a wide moat, strong financial metrics, and good forward-looking data. If we believe that, well, we can see even after the increase today, it is trading pretty much at a 10% MOS level. Now, if you do believe it does need a little bit higher, then something around 15% would be a buy at 165, 20% at 155. But right now in today's episode, the MOS level is 10%. How about Wall Street? Well, in today's episode, they believe the share price will go to around $190. They have revised their price target after yesterday's earnings. They see 9% upside. So in conclusion, for Alphabet, we see a 10% MOS level based on our estimates and judgments. Wall Street considering this 9% upside. Let us know your thoughts in the comments below. Is this one that you're buying? Maybe you are a shareholder and you are excited for those dividends, or maybe you're on the sidelines waiting for a drop to get into what is now a new dividend-paying company. If you have watched our other episodes on Alphabet, we do talk about how this is essentially the cheapest tech company in the Mag 7, how it does look like a very strong buy. However, now the share price has gone up, we can see it is looking like less of a bargain at the $175 mark. So right now, this is one that I purely only hold indirectly via ETFs. But do let me know your thoughts below. And in previous episodes, we have also talked about the issues around this company, around the very high share-based compensation. But again, that is something we can revisit later on. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.